Hi folks, this is Sean Hyman, and I want to talk to you today about combating rising fuel costs with currencies. You know, if there's something that people are concerned with and keep track of, whether they invest in the stock market, commodity market, currency market, or any market, they track gasoline prices. And why do they do that? Well, it's one of their biggest costs. I just put $97 worth of gas in our Lincoln Navigator, and that's not even with $4 gasoline. I think it was in the 330s. And so imagine what that comes to when gasoline goes to $4 or above. In fact, fuel cost is so high that sometimes people pay as much in fuel costs per month as they pay for their car payment each month. And so it's a very very high cost. Sometimes people track bread, sometimes they track milk and butter and things like this. But I haven't bought $100 worth of bread or butter or milk ever. But weekly, I put that much in my tank, and so I know that you guys get concerned with it as well. And so I want to talk to you about one of the ways to combat that. This is a chart of gasoline that we see here, and you can see that gas prices declined from May of last year all the way through to about arguably October to December, because it really kind of set up a range right in there. And gas prices broke broke their downtrend line in late December, going into January, into the new year 2012, and have soared ever since. And I believe there's a good chance that we're going back to $4 a gallon gasoline. But nonetheless, with this rising trend, normally the only thing a person can do is reduce their standard of living. I've known people that have had to cut off services that they had before that were extras, but were nice extras in life, just to cover their fuel costs. So here's a better way to do this. So when gas prices are on the rise like they are now, and I believe this will continue, even if there's pullbacks along the way, I believe ultimately they head higher. You can look to the Canadian dollar. You'll notice that the Canadian dollar tends to fall pretty much the same trajectory. It bottomed in August, based sideways through December. Gasoline prices broke a little first and were a kind of a leading indicator for the Canadian dollar, led the way, broke in January, and a couple weeks later in January, the Canadian dollar broke and started heading higher. And so the Canadian dollar is an oil currency. It's a commodity currency. They're a huge oil exporter. Gasoline prices largely go up because of the oil dynamic, the price of oil. And keep in mind that this is the chart of gasoline futures without the taxes added in. So when you see that it's $3 here, that's not $3 at the pump. There's taxes over and above that as well. But nonetheless, it shows you the trend of the actual fuel itself, because taxes are fairly steady. So as fuel costs head higher, and I believe they'll continue to, by buying the Canadian dollar, which you can use an ETF, FXC, to do that through your stock brokerage account, or if you want to take a little bit of money and lever it, you can do the same thing in the forex market, the currency market, by opening up a forex account with a forex broker and shorting USD/CAD. So shorting dollar CAD in that pairing, and those will both accomplish the same thing. So if you've never done it before, a good way to start out is with FXC. But if you really want to maximize the effect and take a little bit of money and have it cover quite a bit of your fuel expenditure and the actual rise in the cost of living as far as your fuel costs are concerned, then you ought to consider opening up a forex account and trading the Canadian dollar. Also, another great pair that is soaring right now in light of rising fuel costs is CAD yen. It's a cross pair, CAD/JPY. And so the Canadian dollar is strengthening across the board, whether you look at Euro CAD taking it down lower, dollar CAD higher, CAD yen higher, etc. And so the Canadian dollar is just strengthening right across the board. So um, this oil exporter does very well in the midst of rising fuel costs. Hardly anything or anybody benefits from rising fuel costs or rising oil costs, either one. And so if you get on the side of the one that benefits, then you're going to do well. So you want to hop on board something like the Canadian dollar and ride it up as fuel costs head up. The profits and appreciation that you make in the Canadian dollar will go a long ways towards hedging and taking some of the sting out of the cost of what you're having to do and putting fuel in your actual gas tank. So I just wanted to leave that little tidbit with you. You don't always just have to tighten the belt when higher fuel costs come if you know uh, how to use currencies to your advantage, particularly in the forex market where you can get some leverage and make a bigger difference. So thanks so much for watching, and God bless. Bye bye.